Warren Buffett preparing for a crash like 2007, what investors should know. Warren Buffett, the legendary investor, has always been known for his long-term investment strategy, famously holding stocks and rarely selling. However, recent actions suggest that Buffett might be preparing for a market crash similar to the one in 2007. He has significantly increased his cash holdings, now more as a percent than before the 2007 financial crisis, and has sold a substantial portion of his stock positions, including 2/3 of his Apple shares, which was his largest stock position. Understanding Buffett's recent moves. Buffett's actions have raised eyebrows in the investment community. Is he losing his touch in his old age, or does he know something that the rest of us don't? To understand his strategy, let's examine the current market conditions and why Buffett might be preparing for a downturn. The high price of stocks. One of the first indicators to consider is the price of stocks. When stock prices are high compared to historical averages, they are more likely to revert downwards. A key metric to evaluate this is the S&P 500 PE, price-to-earnings, ratio. The S&P comprises 500 of the largest and most well-known stocks in the market. The PE ratio compares the price you pay for a stock to the earnings you get in return. Currently, the S&P 500 PE ratio is 30.6, indicating that prices are 30 times higher than the earnings of the stocks. Historically, the average PE ratio is around 16, which means we're in an expensive market. The Buffett Indicator. Buffett has often cited the Buffett Indicator as a reliable measure of market valuations. This indicator compares the total U.S. stock market value to the country's gross domestic product, GDP. Anything below 84% is considered significantly undervalued, while anything above 156% is significantly overvalued. Currently, this indicator stands at 211%, suggesting that the market is not just overvalued but significantly so. Before the 2007 financial crisis, this indicator was at 105%, and even before the 2000 dot-com bubble, it was at 138%. The role of interest rates. Since 1981, the stock market has generally been on an upward trajectory, with the S&P 500 rising from 346 points to over 6,000 points. A significant factor in this growth has been the decline in U.S. interest rates, which have dropped from 19% to near 0%. Buffett has often said that interest rates are like gravity on stock prices. Lower interest rates reduce the gravitational pull, allowing asset prices to rise. However, with recent increases in interest rates, there is a risk that this trend could reverse, potentially pulling stock prices down. The yield curve and recession risks. The yield curve is another important indicator to watch. Historically, an inverted yield curve has been a reliable predictor of a recession, and recessions are often accompanied by market crashes. Currently, the yield curve is deeply inverted, more so than it was during the 2007 to 2008 financial crisis. Historically, a recession tends to follow an inversion within 6 to 18 months. Other economic indicators. Unemployment rates and consumer sentiment are also crucial indicators. Unemployment typically decreases gradually and then spikes sharply during economic downturns. Recently, we've seen a slight increase in unemployment, which could be a precursor to more significant economic challenges. Additionally, consumer sentiment has turned negative, reflecting concerns about future business conditions amidst high interest rates. Buffett's investment philosophy: what should investors do? Despite these indicators, Buffett's general advice has always been not to wait for a crash before investing. He advocates for holding stocks long-term, regardless of market conditions, as this approach is beneficial tax-wise and allows for compounding growth. Buffett has famously held stocks like Washington Post, Coca-Cola, and Gillette for decades without selling. The importance of holding stocks. Buffett's strategy emphasizes owning pieces of businesses over time rather than holding cash, which loses value due to inflation. Stocks, representing ownership in businesses, generate profits and grow over time, making them a better investment than cash. He advises having enough cash to feel secure, but not as a primary investment. Buying index funds. For many investors, Buffett recommends buying index funds. This approach allows investors to benefit from market growth without needing to predict individual stock performance. He famously stated that investing in an index fund and ignoring market headlines would have turned a $10,000 investment into $51 million over several decades. Buffett's current strategy: selling major stock positions. In recent times, Buffett has deviated from his usual strategy by selling significant portions of major stock positions, including Apple and Bank of America. His reasoning is partly due to tax considerations, taking advantage of lower capital gains tax rates before they potentially increase. This strategic move highlights Buffett's adaptability and foresight in managing his portfolio. Building cash reserves. Buffett's Berkshire Hathaway now holds over $325 billion in cash, more than the GDP of countries like New Zealand and Portugal. This cash position represents 50% of his U.S. stock equities, a level not seen since before the 2007 financial crisis. By holding cash, Buffett ensures flexibility and security, allowing him to capitalize on future investment opportunities. Conclusion: should you follow Buffett's lead? So, is a market crash imminent? While no one can predict the exact timing of a market downturn, Buffett's actions suggest caution. His strategy of selling stocks and holding cash indicates preparedness for potential market volatility. As investors, it may be wise to consider a similar approach, balancing investments in stocks with a sufficient cash reserve to navigate uncertain times. Ultimately, Buffett's philosophy of long-term investing, owning quality businesses, and maintaining financial flexibility remains a guiding principle for navigating the complexities of the stock market.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.